We've got a blockbuster of a week coming up, not least because we've got the latest US Federal Reserve and Bank of England monetary policy decisions due, and they come on Wednesday the 21st and Thursday the 22nd of March respectively. Now, according to the CME FedWatch tool, markets are putting an 89% chance on an interest rate increase of 0.25% to 1.75% when new Fed Chair Jay Powell hosts his first meeting of the US Central Bank. That would be the sixth interest rate rise of this upcycle that began in December 2015. Now, markets are pricing in 3 1/4 point rate rises in the US this year, although some pundits have suggested there could be 4 or even a half point increase in the mix, as Mr. Powell seems to be taking a tougher line than his predecessor Janet Yellen. Also remember that the Fed is slowly unwinding its quantitative easing or QE bond buying program at the rate of $20 billion a month, though that steps up to $30 billion, $40 billion and finally $50 billion a month in April, July and September respectively. As for the Bank of England, the consensus view is that Governor Mark Carney will leave interest rates unchanged at 0.5% and also leave QE unchanged at £445 billion in purchases of UK government and corporate bonds. The key to Mr. Carney's comments is whether he lays the groundwork for 0, 1 or 2 quarter point rate rises this year. Markets are currently expecting 1 in December, but some economists have suggested the Monetary Policy Committee may take a look at an early move in May alongside the next scheduled inflation report. For the moment, inflation stands at 3% on the Consumer Price Index, a full point above target, but it remains to be seen whether this is the start of a real surge or just the result of the pound's weakness and oil strength in 2017. On the corporate front, 4 FTSE 100 and a good selection of FTSE 250 companies are scheduled to release results or trading statements. They include house builder Bellway, online grocer Ocado, and oil services giant Wood Group on Tuesday the 20th, Secure Trust Bank on the 21st, hazard detection specialist Halma and clothing retailer Ted Baker on the 22nd, and on Friday the 23rd, another retailer, Next, and FTSE 100 pumps to scanners to medical equipment conglomerate Smiths Group. But the stock perhaps most capable of causing a fuss in the week ahead is DIY retailer Kingfisher when it releases its full year figures on Wednesday the 21st of March. The company is the owner of B&Q and Screwfix in the UK, and Castorama and Brico Dépôt in France, and indeed for that matter across Europe. This is probably no easy place to be given how soft consumer confidence is, at least in the UK. But as we can see here, the shares are trading at close to their 12-month highs, following a tremendous run since the autumn. 3 factors seem to be at work here. First, November's third quarter trading statement showed some improved momentum in like-for-like sales growth, even if I'm sure that boss Véronique Laurie would rather have seen an increase in like-for-like sales at constant currency rather than the third straight year-on-year drop. That said, the UK actually grew 1.5%, the international businesses grew 2.7% helped by Poland, and the problem was France, down 4.1%. Second, Kingfisher finished off its £600 million share buyback programme in December, only to promptly top it up by another £20 million. And finally, management has stuck to its guidance for pre-tax profit of around £785 million, pending foreign exchange movements, despite that slippage we've seen in the top line. This may foster confidence in the chief executive's view that the mildly disappointing first half profit was a blip, owing to disruption caused by the wide-ranging 5-year One Kingfisher turnaround plan. Now, this is the second year of that One Kingfisher programme, which has 2 main thrusts: to generate a £500 million profit uplift over 5 years through higher operational efficiency across the brands, better sourcing, cutting costs, and improvement in the digital offering, and an additional £600 million in capital returns above and beyond the regular dividend payments. It's too early to judge, really, whether the plan is working after just 2 of the 5 years. But analysts, when they look at these full year figures, will be homing in on 3 numbers in particular. The first is like-for-like constant currency sales growth for the 4th quarter. Will it go back to positive territory? The second is, of course, how close the company gets to that £785 million pre-tax profit figure. That compares to a figure of £787 million a year ago, excluding the costs of the turnaround programme. And the third is the dividend. Kingfisher increased its interim payment by 2.5%, and the consensus analyst forecast is for a 2% increase in the total full year figure to 10.64 pence a share. That's enough for a 3% yield on a share price of around 350 pence. Also watch for updates on the One Kingfisher targets and any guidance for the fiscal year to January 2019. The current consensus is for pre-tax profit before transformation costs of around £825 million. Thank you for watching, and I look forward to seeing you next time.